Don't buy you a condo until you watch this video. Tell your wallet to listen here for some really good info. Hey, it's Matty Loans. Want to play lender? Well, allow me to drop some chords on this edition of LPL. Let's play lender. So you want to buy one of these beauties by the beach? A home for you is a loan for me, but understand, condos can get tricky, and lately condos have been in the news for a whole lot of the wrong reasons, and mostly linked to rising costs. Here's one from Florida. It says they sold their home for 42% less than what they paid for it, not due to the dues, but due to some hefty assessments. Here's another in the great state of Hawaii, with some HOAs offsetting the rising insurance premium costs with a less than 100% replacement cost coverage. Rather unfortunate circumstances, but understand when a lender is qualifying you for these property types, you're qualifying more than just you. It's part and parcel that the lender performs due diligence on the community or the HOA where you're buying. HOAs, management companies, and the 1076 form is the topic of discussion today. And together, we're going to play lender with the most important form to understand when purchasing a condo. And likely before a lender funds your loan, they may require a project review of your HOA. Initially, the project evaluation will cause a lot of heartburn, but for good reason. Perhaps if you understand how the bank treats these property types from a risk standpoint, it'll give you an upper hand when making a business decision. Who knows if this will ever save you from a six-figure assessment or a risk of higher premiums, but it's better to have and not need than need and not have this info. I want to see you buy on your terms and sell on them too. So let's get after the FNMA Form 1076. It's 2024. Housing's expensive, inventory is still limited, and that may make some potential buyers or borrowers consider other alternatives to the plain vanilla single-family detached home. The choice can be for a variety of reasons. It's located in an urban area, maybe it's a second home and you don't want to shoulder all the regular upkeep for another property. It could be a business decision like downsizing or your pathway to your first home. Whatever the choice, it's yours. Just understand that there are layers to this game, player, tiramisu. And if you're financing a condo, there could be a good chance your lender will hide behind a project review before you're approved and you can close your loan. And here's why. If the community of where you're buying is not already approved by Fannie or Freddie and on file with your lender, it's more than likely your lender will need to contact the Homeowners Association for help completing a condo questionnaire, Fannie's Form 1076, that provides some of the specs on the development and its constituents. The questionnaire is more than a few pages long, and it outlines all the hot-button topics regarding the control, the financial health, insurance coverages, rules on use and reselling, and splits on occupancy. Because the HOA controls policy and makes decisions that impact their owners, your lender will want to review them and understand the inherent risks of said association. Odds are that'll be determined by the mortgage giants, Fannie Mae and Freddie Mac. As you know, Fannie and Freddie are the government entities that take loans off your lender books so they can keep the real estate mortgage market churning. Each mortgage is pooled to the GSEs that will then be sold to mortgage investors, which make up the secondary market. The end investor will review these loans as that interest becomes their income. Remember, lenders and their investors are interested in collecting the coupons, not the properties. True for condos like any other property when you leverage financing. Now let's review the Homeowners Association and the structure so you can understand how it relates to your loan. HOA, or Homeowners Association, is the governing mechanism that manages the condominium project. It's possible to have an HOA for a townhome or a planned unit development as well. HOAs are typically managed by individuals that sit on the board, and the board forms the rules and regs to manage the community. A lot of people don't like the idea of an HOA because they control the color of the doors, what holiday decor for display, if you can or can't have solar panels, and even where you can park your vehicles and what type of vehicles. Watch out if you're looking to set up a short-term rental. Many HOAs ban these, if not limit the length of term. But if you're planning to buy in an HOA, it's important to review the CC&Rs because you can't opt out of the HOA. Every HOA will have fees to pay known as dues. Dues could be monthly, annually, semi-annually, or quarterly. They will often have special assessments based on decisions made by the HOA board based on scheduled improvements and reserves for emergency and hard times. Each community is different and will establish dues based on the community budget to maintain all the units and all the shared space, pools, landscaping, roofs, walls, gates. Now, the board will not do this on their own. Usually they partner with a management company to take stock in the operation of the budget and execution of the maintenance. All of these details matter to the well-being of the homeowners association and the impact it could have on the buyers and the buyer's mortgage. How does your lender determine what is a good risk? Well, they have standardized this using a condo questionnaire. The lender may request that the HOA or management company complete the condo questionnaire before granting the loan. Not only does this cost more time, but it creates more paperwork, fees, and frustration for you, but also think of your lender. Well, the cost, that's on you. Lenders don't make anything on the fees, but blame the HOA for the associated cost. They organize it. Usually the condo questionnaire costs a few $100s and takes a few weeks, and it's non-refundable just in case you decide to not go with the transaction. The frustrating part for the lender involves tracking down the management company, then to relay all the most important disclosures and evidence of insurance. Often we'll have to get help from third-party management companies like a homewisedocs.com where you're limited in email communication. On top of it, when the duties are outsourced, it may be hard for your lender to get complete answers to specific needs like the deductible amount or percentage. Another part of the frustration is that the condo questionnaire form will change from time to time. Everything has an expiration date, especially in the loan business. And I remember contacting HomeWise once with a special request and an extra fee to have the form completed on the lender-specific form. They didn't complete the form I requested. They sent back the form from what was on file from 2 years ago. These forms are routinely updated, and sometimes questions are added or the same question reworded or requires commentary and additional follow-up. Now, depending on the status of the project or the HOA, it may even call for an attorney opinion letter. I've even had the difficulty of refinancing a client from a year ago, and in less than 10 months, the form was outdated and required an updated project approval. Or perhaps some of the HOA data itself has changed, maybe for the better, and the project is no longer warrantable. More on that later. Some of the impetus to update the form depends on real-life events like the Champagne Tower in Surfside, Florida. The incident revealed to everyone involved with an HOA that often these buildings lack the required maintenance. It could be a problem as ID'd in this article of who is responsible for paying for the deficiencies. Usually that means you, so it can impact your ownership. Because of this liability, Fannie and Freddie may avoid purchasing loans under high-risk scenarios. As a result, they have intensified their review of the HOA documents, including the specifications, to structural review and the HOA's ability to pay for these. Remember, whatever the HOA says goes. So if that means it takes $100,000 per owner to bring it up to speed, it could force you to sell and then lose way more than you can afford. Once these problems are identified, it may make it harder to buy with a loan as well. Hence the request and review of the docs and the project approval process. We all know banks are risk adverse and condos are inherently risky properties. These important decisions, who to contract for the roof, who to maintain the structural integrity, depends on the judgment of the board. Hopefully they're taking bids and not delegating work based on politics. Some board members have experience, some don't. Perhaps they've served on a board before and they've learned the tricks of the trade, or maybe they're an attorney. Once you own, you vote, but the decision on how to spend your money via dues is out of your hands. Lender due diligence is a good thing, and you should pay attention. One of the major asks on the Form 1076 involves pending litigation. The lender may want the backstory of the lawsuit and what considerations could be made based on the ruling. Pending litigation could be more common in some states than others. In California, for example, they have a 10-year window to come back to the developer for defects on construction. It may or may not be a big deal, but that's a responsibility of the lender and you. For example, if there was a defect in the construction of the roof and the roof leaked for years, it could create a health hazard exposing inhabitants to mold. A homeowner could notify the homeowners association and the HOA notify the management company. It's great if it's remedied, but if it wasn't completed timely or done improperly, it could lead to a lawsuit and then become a big sandwich that we all have to bite. I've seen it where the lawsuit was significant and the lender wasn't going to lend on the project until we had an attorney opinion letter stating the likely outcome. It was painful. This is the aim of the condo questionnaire. Besides a litigation issue, if a new building, you may want to get intel on the total project, number of phases, and understand what's completed or not completed on the phase in which your property is located. It may matter how many units are in the new project or pre-sold. New or existing, the lender will ask for copies of the master insurance policy, review the occupancy rates of the building where the unit is, see if any of the units are behind on the dues, and if there are any shared elements or commercial space. So what are the right answers to all these questions? It's high stakes because if you don't have the right answers, it could cause your lender to pass on your condo dream home. It could be assigning your projects what they call non-warrantable. A non-warrantable classification means it may not meet requirements for Fannie Mae, Freddie Mac, or other government-sponsored enterprises, the GSEs. The secondary market wants to set forth requirements that the HOA is financially secure and well managed. Typical reasons why your property may be non-warrantable, as ID'd on the 1076, include the following. Section 1, number 8, hotel, motel, holiday inn, or just short-term rentals, or restrictions on use. Section 2, number 2, who's in charge? Does the developer still have control over the HOA? Section 4, number 1, how many unit owners are more than 60 days delinquent? If more than 15%, could be too high. Also, if dues are more than 6 months passed on to the lender. Section 4, number 3, is there any pending litigation? Section 5, number 1, how many units are pre-sold? Or bigger scope, how many units are sold owned by investors? The percent of rentals could suggest that the project is financially unstable. GSEs don't like majority investor occupied or more than 50% investor occupied. Section 5, number 2, number of units owned by the same individual or entity. Typically, this is limited to 10%. Section 5, number 5, amount of commercial space, typically no more than 20 to 25% is permitted. Section 7, number 3, are there any deficiencies? Safety, integrity, and habitability. Are there any? And last, Section 7, number 9. How much are in reserves? If less than 10% of the budget is allocated toward reserves, it could be a no-fly zone. If one or more of these issues are revealed on the 1076, it may mean that it's a non-warrantable condo, and therefore you may have to find a lender that offers financing for these situations. Now, the project may be non-warrantable temporarily, so just because it is now doesn't mean it'll always be non-warrantable. Many new projects start off non-warrantable, but as they're sold and closed, it'll come online for the GSEs. But if these challenges are identified, it may be worth reconciling or making a business decision. Now you know a little bit more about the form and what information the lender's after. But the form alone isn't the entirety of the material needed, if a full review. Besides the questionnaire, the lender will also want to review copy of the current annual budget. If the association is not setting aside at least 10% of its monthly income toward reserves, it's a fatal problem. Reserves must be a line item in the budget. If a condo HOA has a current third-party reserve study that proves it already has adequate reserves, that can work in lieu of the 10% reserve rule. But I can't ever recall this ever being the case. The bylaws of the association look for things like deed restrictions or right of first refusal, articles of organization, aka the HOA's articles of incorporation, which are legal identifying documents. Also, copies of the master insurance, flood, or environmental insurance needs if applicable. But beware that with increased insurance costs, the lender will want to review deductibles for items like water damage and will limit it to 5% per unit. Understand that a full review is not always necessary. There is a reduced documentation review known as a streamlined or limited review. This type of eval is more likely on established projects with large amount of equity or down payment. It may call for the insurance so that the new lender can be added to the master. And that's about it. Last, just because you're part of an HOA doesn't mean that you need an HOA reviewed and questionnaire. There are examples where you get a waiver on a project review, like detached condo units. You own the land and the property doesn't have any shared walls, ceilings, or floors. Or units in a 2 to 4 unit condo project. Due to the number of units, it's not a major concern. Also, units in a PUD project. Say you own a parcel in Green Acres. No reason for alarm. Last, Fannie Mae to Fannie Mae limited cash-out refinances with LTV ratios less than 80% and high LTV refinance loans. Sometimes you have to check with the appropriate authority to confirm the property is really a condo. Often you'll see a property marketed as an attached townhome when really it's deeded as a condo. If it does not meet the 4 types, it may require the review. See, the developer will get certain zoning advantages or tax incentives to construct it as a condo. Nevertheless, it may feel and look like a townhome. Last, the 1076 is the standardized form. Like all mortgage nebulas, it is a form, but it may not be the form. Your lender may use this one, or they may use their own. Small detail, but matters. Well, I'm Maddie, and remember, I always got your back. Hope to see you again soon, because right now I got a terrible song to work on. Go into the HOA, make them fill out the form. Hope they approve my customer, and make them sit on the board.